Hello students, I hope you all are doing well. Welcome to the Recitals in-depth by Vajiram Ravi. Here we will be covering the month of May 2024's economy and infrastructural current affairs topics in detail. The broader themes that we are going to cover today are as follows: Indian agriculture, money and banking, public finance, investment and infrastructure, and social development. So let's get started. Recently, the Chief Economic Advisor of India warned Indians about Sachetisation of F&O trade or futures and options trade. Now, to understand this, we have to actually understand what are actually futures and options. Now, when we talk about futures, we are talking about futures contracts. Now, imagine a situation that there is a farmer, right, who wants to sell his agricultural produce. For example, he has 100 kilos of rice and he wants to sell this 100 kilos of rice at, for example, say 100 rupees per kilo, right? And for example, he is not yet ready with the harvest of the rice because he has just, say, planted or cultivated his land. So maybe his harvest will be ready within a period of 3 months. Now, between these 3 months, the farmer is actually thinking of finding a buyer. So what he does at the beginning, when he just cultivated his land, he went to the nearest mandi and he found a buyer at the mandi. The mandi buyer, he told that, okay, I am willing to buy your. Now the mandi buyer, he told that I am willing to buy your rice. Okay. Now to sell your rice, you have to enter into a contract with me, or say legally binding agreement with me, that after 3 months you will be having to sell me the rice, right? The entire 100 kilo of rice at 100 rupees per kilo. Whatever you are willing to sell me, I am agreeing at that price. No issues. You enter into a contract with me, I am willing to sell it. The farmer is also happy. He thinks that, okay, at least for a period of 3 months, and also after the 3 months, the price of his produce will be constant at 100 rupees. Because in the meantime, the market price of rice can fluctuate, right? Say for example, after 3 months, right, when he is actually harvesting the crop here, at the time of harvesting, the farmer saw that the price of the rice has now decreased to 90 rupees, while he was expecting 100 rupees in the, before 3 months. So it is actually good for the farmer to actually lock in the price for 3 months and finally sell everything to the, seller. Now there can be other thing also. For example, the price of rice has increased to 120 rupees. So in this case, the farmer will be losing 20 rupees per kilo. But again, it is a kind of an assurance on the farmer's side that he will be at least be selling all of his produce and not lay this produce to waste, right? So that is what we have to understand. This is a kind of a contract which is actually dealing with commodities, in this case rice. It can be dealing with stocks also. It can be dealing with commodities. It can be dealing with any mutual funds. It can be with reference to any assets. Where at the end of 3 months, both the farmer is under the obligation to sell the rice to the mandi owner, and also the mandi owner is also obligated to buy the rice from the farmer. Why? Because it is a legal contract. That is why, right? And here, for this entire thing to be taken place, there must be another person who is actually the stockbroker, or say there may be another intermediate person who is actually, maybe can be a lawyer even, is actually enforcing this contract. So for this, both the farmer, right, is maybe say depositing some money for this contract, and also this mandi owner is depositing, say for example, partial payment of this particular contract here. So there will be also margin deposit, which is actually giving assurance that, okay, after a particular period of time, this contract is actually going to fulfill, right? And finally, the delivery will also be of the final goods and services if it is a case of commodities, right, or say cash if it is a case of say stocks or other mutual funds, right? The final delivery of the commodities also has to be ensured, and the cash for stocks and the mutual funds has to be ensured. And finally, it is regulated in India by Forward Markets Commission. right? So this is the main regulator of futures contract in the country. Now, after understanding the futures contract, let us go on to options contract. Now, this is also very interesting. Now, say you are an investor here and you want to invest, for example, say in a company known as Adani stocks. Now, for example, you heard from somewhere that Iran government has actually gave a port to Adani. Now, obviously, you understand, if Iran government is, say, giving the port to Adani, for example, say in a period of 3 months, you are assuming the Adani company will be developing this port and starting its business operations. So you expect that after 3 months, maybe the stock of Adani, which is right now 100 rupees, it will be increasing to 200 rupees in a matter of just, say, 3 months. So what you do immediately, you contact a broker. You contact a stock broker who is having right now the stocks of Adani, right? So you call him and you tell him, okay, you do one thing. You are telling the stock broker that you do one thing. You hold 100 shares in my name, right? And after 3 months, I will be giving you 150 rupees for each shares. Right? You understand this, that right now the market price is 100 rupees, right? And you know a broker who is having a lot of stocks of Adani. So you contact him and tell that you hold 100 stocks for me, and after 3 months I will be giving you, right, 150 rupees. Why you are doing this? Because you understand that after 3 months the stock's price will be 200 rupees. So that is why you want to have, say, a profit margin of more than, say, 50 rupees, right? So in this manner, this is actually how people involve in option contracts. Option contract means that you do not have the stock with yourself. The broker is having the stock, and the broker will be agreeing to keep the stocks for you, say, for 3 months at a strike price of, say, 150 rupees. Right? Now, for example, say after 3 months, you see, for example, the price of the Adani stock is, for example, say at 170 rupees. It did not reach 200 rupees, but obviously it is more than what you have promised the stockbroker at 150 rupees. Now, obviously, the stockbroker will not be selling you at market price. It will be expecting that thus you will be giving a little more at 150 rupees. And also after 3 months, you saw that, okay, 170 is the price right now, so you can have a profit. So after you have this profit, right, for example, you saw that the market price of Adani stock is at 170 right now, you immediately call the broker and tell, okay, you right now deliver the stock to me, right? Because you have the right under this option contract to call for the delivery of the stocks if you want it. But if, for example, the market price of the Adani stock has decreased to 120 rupees because maybe the Iran government has cancelled the contract of Adani, so it will be, so for example, say not increasing by that much amount that you have expected, right? So what will be happening? Then you saw that the market price has not increased according to the strike price that you have promised to the broker. So you will be suffering a loss here then. So in this case, what you can do, you can tell the broker, okay, under option contract, I have the right to buy, but not the obligation to buy the stock. So what you can do in this case, you just have to pay a fee to the broker, right? In this case, where the market price has gone down than that you have expected, you have to just pay a fee to the broker. But is the fee only be payable in this case? No, the fee has to be payable in all of the cases. That means the broker will be always be charging a fee for any of the option contracts that you are actually dealing with the broker, right? So this is how this entire option contract is happening. It starts with you expecting a company's stock to be increasing in future, price to be future. So you contact a broker who is having the stocks. So you directly do not buy the stocks, right? So what you do, you tell him to book, say for example, a quantity or number of stocks for yourself at a particular price in the future. If this particular price is met more than that, right, you will be exercising your right to buy the stock stocks, and the broker will be delivering you 100 stocks of this particular company. If that is not case, if that is not, then you are obviously suffering a loss and definitely will be not wanting a loss. So you will definitely cancel the contract, and by cancelling the contract or whenever you are signing the contract, you always have to pay a fee. So in this case, if you are not being able to book profit, you are just giving a fee to the broker in this manner. So here the main features you have to understand, that here you have a right to either buy or not buy, right? And here you are under no obligation to actually, if you are suffering any loss, to either buy it or sell it, right? Or say if you are having profit or no profit, you are no obligation to actually exercise the contract. But definitely you have to pay a premium for this contract. Whenever you are entering a contract into with a broker, you have to pay a fee. The fee can be, say for example, say 2% of the entire transaction, right? So if you are suffering a loss, your loss will be only this margin. And in India, the option contracts are regulated by the Security Exchanges Board of India, the SEBI. And here, generally we have two types of options contract. We have the call and the put. Generally, whenever you expect the stocks prices to increase, you exercise a call option. Whenever you expect the prices of stocks to decrease, you exercise a put option. So for your prelims examination point of view, this is more than enough that you want to know in this topic. Now, actually going into the particular main discussion here, we find that futures and options are actually much more advanced than normal stock trading or normal mutual fund trading. They are in effect very risky. Why? Because there is this element of time involved in the stock market, and in a particular stock market or in any economic condition, time can change the prices and can make the things very volatile in the market. And that is where you have to understand that the risks with futures and options trading, the call put options or the put call options and so on, they are very risky in nature, as can also be seen in this particular figure, the figure released by SEBI, right? In India, the 91% of the people or say the traders in the stock market suffered losses in the futures and option equity segment, right? Or say the futures and option segment here. Then also we can find that the average profit made by the profit makers are very low, but the losses are very high. This is a very serious thing. Why? Because we have to understand, in India, we obviously have big stock market players, but the majority of the Indian investors are retail players or the retail stock market investors. They are generally coming from humble backgrounds, say even sometimes they come from poorer backgrounds. So if by the lure of higher profits in F&O margins, they go into this market, they suffer losses, their entire households, their entire economic conditions will be very in a negative state of mind. So that is why you have to understand this F&O are increasingly becoming very risky. So this is one side where the risk with F&O is actually provided with kind of real-time losses by the people. Now, second is that about the financial knowledge of Indians. According to a report in the Hindu, we can find that in India, obviously we find there are many trends in the financial literacy scenario here. When we talk about male and female, it is a male population who is more financially literate, or when we talk about financially literate, we mean they're having information of various, say, stocks, right? They're having information of, say, for example, UPI, for example, the banking economy, right? And say, for example, other market related situation, right? So this is about financial literacy. This is also about the awareness that you have about financial products, financial scene of the country. So here we find that the male population is having more amount of financial security. Also, when we look at the demographic age of the population, we find that the people between 20 to 39 years of age are having less financial literacy than the senior citizens of the country. So this is also one of the reasons why more of the young people are actually being trapped in this kind of stock market trends. Also, when we talk about the various people, when we talk about the occupations, right, we find that the self-employed, homemakers, the daily workers, they are not having that much of financial literacy with reference to the retired or the salaried class. Also, we find that the students from the 12th level, they are also having less amount of financial literacy. Also, we find that the people from different income classes, so there are varying amount of financial literacy in this manner. So that is what we have to understand. Financial literacy, or say illiteracy in some portions of the population, combined with the potential loss making of this segment, make it very, very risky. And that is where our own chief economic advisor is warning that Sachetisation means the, say, breaking down of F&O trade into small products, where these people, or say retail investors, small retail investors, can actually invest in. For example, say it can be starting from say 100 rupees or say 1000 rupees. So this is actually practiced by the main asset management companies or the stockbrokers to actually increase their consumer base, or say consumer market. So to actually increase their consumer market or higher profit, the companies are not realizing that they are leading to sachetization or breaking down into small financial products, which is actually leading to losses of the countries. And here we have to understand a very important quote said by him, that whenever financial sector development precedes national development, it is not ending well for the other countries. This was seen in the Asian financial crisis of the 1990s, when in the major Southeast Asian nations, even nations such as Japan and Korea, they found their stock market to be in a bubble, because there were many small investors who were investing in this F&O, right, and various other stocks and so on, which has led to risky tendencies and loss of assets to the people. So this is where they have to be very, very careful of. And also, when we talk about the overall savings rate in the economy, right, we find that over a period of time, right, particularly say when the COVID pandemic actually struck here, right, from that high savings to GDP ratio, right now the savings to GDP ratio has declined over a period of time. This is also accompanied by the physical savings and also the net financial savings over the GDP ratio. So we find that recently people are not investing, right, too much in their bank accounts. What is the trend here? Right, over a period of time, as we can see, over a period of time, people are investing more in mutual funds, in direct equity, and also in other financial products such as futures and options and so on. So we find this is the trend which right now the Indian financial sector is going towards. And this should not be replacing the overall say national development, because we find economic growth is something on the other side, and financial sector development growth is something on the other side. Financial sector development generally means the more amount of equity or shares or F&O that the peoples are having, but these things are very risky, right? Instead, if people are focusing more on national development, or say building more and more of savings, they can do so in the banks. And if they are doing in the banks can invest them into infrastructure sectors, into welfare sectors and so on. So this is actually leading to overall greater development of the nation and improvement of the GDP over a period of time. But more and more risky state of affairs, particularly through this data, right? Particularly because India is investing more in the mutual fund companies, direct equity and so on. So this is leading to a risky portfolio. Now, I'm not telling that mutual funds or say this kind of things are not good for the economy. They're definitely good, but everything must be following a particular balance, because we know, as usual, mutual funds and all other investment items are subject to market risk. So that is why we must be taking care of this particular thing. And here I have a question for you all on these particular concepts. Please do let me know the answers in the comments. Recently, the Competition Commission of India has given green signal for NAPINO and International Financial Corporation to actually go over their compulsory convertible debentures. For this topic, we want to understand what is debenture. Now, to understand debenture, imagine that this is a particular industry, right, where this industry wants to expand their branches and business operations. right? They want to expand their business over a period of time. And also this company is listed on the stock exchange. And this is a very, very famous company. So what happens is that if it wants to expand their branches, definitely it needs a lot of money for the same. Now, one way is actually by releasing more and more shares in the market, because if this company is releasing more and more shares, many new investors will be buying the shares and giving the company money. Now, maybe this company X doesn't want any shares to be diluted in the company, because for example, if there were 100 shares, right, now there were 100 owners. Now if the company would be releasing new shares, for example 20 more shares, there will be 20 more owners, and hence the stake or ownership in the company, the percentage ownership, will be diluted in this manner. So that is why the company now thought, okay, let us do one thing, let me issue bonds. Right? Let me issue a corporate bond, because this is a private company. So this private company will be issuing a corporate bond with, for example, the same level of features that the government bond has. For example, a coupon rate, right? For example, a maturity date, right? And so on. But this corporate bond is not backed by any collateral, right? For example, the company has released this bond to take a debt from the people, right? The people will be giving money to the company here, because the people will be expecting coupon rates, or say the interest rates. So here, this debt that the company is taking is unsecured or having no collateral, right? And here, these bonds are also special bonds. Why? These bonds are special due to reason that the companies can actually release some kind of debentures where they can be non-convertible. That means after, say for example, this bond is of 5 years. After the expiry of the 5 years of this bond, the company can simply return back the initial bond money to the people. This is actually known as the non-convertible bonds, where the bonds cannot be convertible to equity. Now when we talk about convertible bond, these bonds are actually converted to equity, or means that, for example, a particular bond is of 100 rupees, right? And after 5 years, under non-convertible bonds, the company should have given back the 100 rupees to the people. But after 5 years, what the company has done, that okay, I will be not giving you the 100 rupees, I will be giving you 100 rupees worth of shares or ownership in the company. Or for example, your bond is now converted into equity, right? So this is a simple way how companies raise their money, right? And later, when the company had to repay the bond, it just converts into equity. That is, it is giving the people the ownership in the company. So these bonds are actually, or compulsory convertible bonds, are those kind of bonds which after maturity, they compulsorily become into, say, equity or say ownership of the company, right? So these are hybrid securities. That means they have some element of bonds also, that is debt, and they also have elements of shares also, that is equity or ownership in the company. Because after a period of time, the bonds can be converted into shares, right? And also these are medium to long term debt security, because the companies want to expand their branches, expand their business operations. That is why it needs money for a long period of time. And also, mostly they are unsecured. As I told in the very beginning, they are unsecured. That means they do not have any collateral backing the bonds. And finally, the people, till they have these bonds, they cannot have any right as a shareholder, and also they cannot vote in the company meetings. Right? Till they have the debentures, they cannot have the right, but after they are converted into equity, into shares, they can then vote into the company's meetings and shareholders meetings and so on. Right? So these are actually the main concept of the compulsory convertible bonds. So this is the case when the recently Competition Commission of India has cleared the International Finance Corporation's acquisition of debentures in a private company, Nepino. Right? Now, when we talk about the individual entities here right now, about the organizations, it is very, very important for our prelims examination to know about both International Finance Corporation, which is actually one of the organizations of the World Bank, right? It is the member of the World Bank group. It is giving finance to the private companies all across the world in developing world, or say in developing countries. The headquarters is at Washington and it was founded in 1956. The main mission is to encourage the private sector in investing in developing countries, improving jobs, investment opportunities, and so on. And when we talk about our Competition Commission, right, which has actually permitted NAPINO and IFC to actually have these convertible bonds, we find that this is the competition regulator of India. That means when we are talking about competition regulator, this is not encouraging any monopoly in the country, right? This is not encouraging monopoly in the country, because we have already looked in the very previous discussions that market economies are actually more efficient to function. But if we have any monopoly, or say one company which is actually gaining in power and status and having greater control of the markets, that is not good for the overall economy. So that is what we have to understand. CCI is actually implemented to reduce the monopoly power of various companies through various rules and regulations. It was established in 2003 and fully functional it became in 2009. And it is a statutory body under the Competition Commission Act. The main objectives are to promote and sustain competition in Indian markets, protects the interest of the consumer, increasing the freedom of trade, and finally a cooperative and competitive business. And finally, when we talk about the activities of the CCI, the main activities is investigate the various anti-competitive behavior of various companies or abuse of dominant position of various companies. It also looks at various mergers and acquisitions to prevent market dominance in any place. It also advocates for pro-competitive policies. And finally, it also collaborates with international agencies on the same manner. So this is where we have to understand the role of CCI is very, very important in Indian economy. Now, there is a question on CCDs, the answer of which I definitely want all of you to write in the comment section. Now, recently a very interesting thing happened. We had two new news anchor in India who are actually from artificial intelligence. They are known as AI Krish and AI Bhoomi, right? Beautiful names, beautiful people. So let us understand who are they. So this is AI Krish. As you can see, he is talking on the Pradhan Mantri Krishi Sinchai Yojana, and he is completely artificial intelligence generated system, right? This is not an individual person. This is an anchor who is actually a part of a computer, and he can actually, let me tell you very smartly, speak in around 50 Indian plus foreign languages, right? So this is a very, very important aspect here. And this has actually featured, Bhoomi and Krish have actually featured on DD Kisan, which is under Ministry of Information and Broadcasting. Right? DD Kisan is the dedicated channel for Indian farmers to disseminate information regarding Indian agriculture to farmers. As you can see here, he is talking about the Krishi Sinchai Yojana, or the main amount of irrigation scheme to develop irrigation channels in the country. So here, as you can see, he is seen as educating the country and the farmers on Krishi Sinchai Yojana, the components, the various schemes, policies, and also the various other kind of weather related aspects of the Indian agriculture. And the main benefit of this AI anchor is that they will be active 24/7. So this is all about the AI anchor part here. And now I want all of you to answer this question in the comments. Recently, the State Bank of India became a stakeholder in the gift city of Gujarat and is giving special functions to the India International Bullion Exchange. Now, to understand India International Bullion Exchange, we have to understand Gujarat's gift city. This is standing as Gujarat International Finance Tech City, where it is India's first fintech city of the country. And here, this is also known as International Financial Services Centers, which is actually established under 2019 statute in 2020, right? And it looks into the main aspect of development and regulation of the financial sector of the country, and it is trying to also compete with the global giants of Hong Kong and the New York financial centers. So this is a very, very important initiative that we all have to understand here. Now when we talk about the development and regulation of GIFT City, it looks into the development and regulation for various stakeholders, for Indian corporates, for overseas companies, for various government or treasury activities. Now when we talk about Indian corporates, IFSCA or GIFT City, it's looking at giving trade facilities such as buyer's credit, RA financing, etc., right? And also external commercial borrowings for the domestic companies in the country, right, to borrow funds from the international market, because in GIFT City there are plethora of domestic banks, or say domestic commercial banks, and also the foreign banks located. So it becomes very, very easy for the companies to go to GIFT City and set up their branch there and raise commercial borrowings in the manner, right? Next, it also helps accepting currency deposits and so on. When we talk about overseas companies, it gives various credit facilities to subsidiaries, joint ventures of Indian companies registered abroad, credit facilities to overseas companies owned by NRIs, and also it gives treasury activities such as investments in overseas securities of other countries, governments and so on, transactions in derivatives, and also foreign exchange related transactions. So if you can see, without going into too much of detail here, so IFSCA is actually looking, or say GIFT City is actually looking at the integration of the entire financial market in the country. And when we understand that in GIFT City, Gujarat, right, we have say around 16 fintechs or fintech companies which are actually doing a great deal of work in the financial technology scenario. We have say international stock exchanges, 2 international stock exchanges at GIFT City. We also have Bullion exchange, that is the International India Bullion Exchange, right? We have insurance intermediaries, we have various amount of fund management companies. Importantly, we also have a multilateral bank or new developmental bank, new development bank under BRICS. The head, so the office of BRICS is also at GIFT City, Gujarat. So it is very, very important that over a period of time, it emerges in something known as a financial giant of the country. And India also wants to promote GIFT City in other parts of the country too. Now, when we talk about the IIBX or India International Bullion Exchange, it is a very, very simple process where bullion is actually traded in the country. Now when we talk about bullion, we mean the buying and selling of precious metals such as gold, silver and so on. So here both the sellers and the buyers can go onto the platform here and can actually carry on the trade of the gold, silver and the various jewelries. The sellers, what you can do, the sellers can get listed on this IIBX, which is also a digital exchange platform. Apart from having a physical presence at GIFT City, Gujarat, it is a total online process where the sellers can go and get registered as bullion dealers, and even the banks can get registered on this particular platform. What they can do, they can deposit bullion at the various vaults and the demat processes there, right? And for this they can get a certificate for the same. So whatever banks and say the jewelers, they have gold with them, they register with the IIBX, they get a certificate for the same, and they can even sell the certificate on this particular platform. Now, who will be buying the certificates there? The various qualified jewelers, even the domestic, say retail investors, they can buy the certificates, and for this, a letter by the IIBX will also be issued, right? And finally, for example, say if there is an international buyer, there will be, for example, say remittance by say a qualified jeweler from abroad or from India, and they will be giving a certificate. And finally, the exchange of currencies will be taking place in this particular platform only, right? In GIFT City, Gujarat, in IIBX. And finally, the buy order will be also placed on the trading platform. So this is a very important seamless platform which is facilitating, right, a large volume of bullion trade on a particular unified single platform. And this is actually making India, second largest in terms of this platform after China, right? So it is, the second largest when it comes to bullion exchange worldwide. And also the main significance that we have to understand, that in this particular IIBX platform, right, the purity of precious metals are a very high priority, and that is why there is very low scope of duplicacies, there is very low scopes of fake bullion that can be exchanged into this particular platform, because they have high standards of credibility on the platform, and the checking and the thorough amount of laboratory tests are also highly specialized, right? Then the amount of price discovery, or say the right price for right amount of gold, which is actually determined by the selling and the buying of gold at market determined prices at totally digital platform, is also very efficient and streamlined. And here finally it can also lead to the growth of the jewelry market in the country, and also it can lead to the growth of the gold usage and say the financial saving of gold in a platform, or say in a financial system of the country. It can also encourage the households which are storing gold in physical form to list their gold on the IIBX platform and hence trade in this manner. So they can actually get better returns on their gold that is just sitting place in their, that is just gaining dust in their houses. So this is how this entire platform is operating in this manner. Now there is a question I want all of you to answer in the comment section below and let me know. Recently the Central Board of Direct Taxes has updated the cost inflation index. Now to understand this, we have to take a very simple example. Now imagine that you purchased this piece of land, a barren piece of land in 2001 financial year, and you purchased it for 1 lakh. And after a period of time, you purchased and you forgot about this land. After say around 24 years, you came back to this land and you saw that this land is developed, right? And maybe right now you can sell the plot that you had here and get better returns. Obviously, over a period of time, the prices of real estate properties, any assets, they increase, right? So for example, in financial year 2024, the price of your asset right now is 5 lakh rupees. Now, in economic terms, long-term capital gains are actually calculated on the final asset value minus the initial asset value that you calculated, that you actually purchased the land for. So the main capital gain here, the simple capital gain here is just 5 lakh minus how much? 1 lakh rupees. So it comes up to be around 4 lakh rupees that you gained in the value of land. Now this is an income for you, right? Now whenever do we have any incomes for any kind of, say from any kind of asset, for example, this can be a land, this can be a house, this can be a board, this can be a painting, this can be any asset, this can be even stocks, right? This can be even say other immovable properties, right? For every kind of assets, we have a particular strategy or formula given by the Central Board of Direct Taxes to calculate the main return and also the main tax liability. Now explaining the main thing, here we find that in this particular example, we had a capital gain of 4 lakh rupees. Now obviously we have to pay some tax on this. This is, for example, let us assume for simplicity's sake, the tax rate is around say 10%. So what is 10% of 4 lakh rupees? 40,000 rupees. Right? So this is the tax you should be maybe liable to pay, right? But here you are missing out one thing. That is, say, the effect of inflation in the value of your land. Now obviously over a period of 20 years, not only your land will be appreciating in value, but also the money value will also be decreasing due to inflation. Right? Over a period of time, inflation leads to the reducing in the purchasing power of the various goods and services in the country. So that is what you have to understand, that the land over a period of time, they can also lose value due to inflation. So that is why we have to calculate the adjusted cost price. So adjusted cost price is the cost price then, the value of the cost price then in now's term, that means in today's term. Right? Now, to actually measure the amount of inflation in your actual land, which you purchased around 20 years ago, you need to find the value of that 1 lakh rupees right now. For that, you have to find out adjusted cost price. Adjusted cost price is having a formula, that is your initial land value, right, multiplied by what used to be the what is actually the cost inflation index right now, that is 363 according to the list cost inflation index released by Central Board of Direct Taxes, divided by say the initial cost inflation index of 100, right? So we find that, right, the adjusted cost price right now is at around 3.63 lakh rupees, right? So this is how you find this say kind of adjusted cost. And here the value of this land, right, 20 years ago was 1 lakh rupees. Right now it is 3.63 lakh rupees, because simply over a period of time there has been inflation. And this chart, as you can see, this chart is having financial years and the amount of inflation that has taken across the various financial years, as you can see here, right? For example, in 2001 the cost inflation index was 100. That means if a particular asset is 100 rupees, in the next year that asset price will be 105 rupees, because there was 5% inflation in between these 2 years. Similarly, we find the same for the next subsequent years. Finally, we find that as of 2022, 2024, 2025, we have this kind of a cost inflation index. So this is actually the real value of your plot of land right now, right? So this is what you have to understand, that this helps us to calculate the real value, because right now you have sold the land for 5 lakh rupees, right? So 5 lakh minus 3.63 lakh is around say 1.37 lakh rupees, right? So this is actually the main profit that you have booked, or say that you have actually gained from selling of this land right now. Now on this profit you have to now pay 10% of tax, as we have discussed earlier, right? So on this you have to pay around say 13.7 thousand rupees only, as compared to the 40,000 rupees earlier. So in this manner we can actually reduce the amount of tax paid like this if we calculate this cost inflation index manner. So this is actually to factor in the real capital gain that you actually had. In this scale, the real capital gain was just 1.37 lakh rupees. Right? So based on this only, we have this question where this MCQ. Please do let me the answers in the comment section. Now recently, Zimbabwe has actually converted its currency and linked its currency to gold, which is known as ZiG or Zimbabwe Gold. Now we have to understand that the main features of this ZiG currency is that it is gold backed. That means the value of this currency is right now linked to gold, right? And this is why, because it is trying to make the Zimbabwe currency as stable as the value of gold at market rates. But does it mean that if you have, say for example, 10 ZiGs, that means you can buy some equivalent amount of gold in grams? No, because you cannot redeem that money for gold, right? So that is what you have to understand, that Zimbabwe Gold is actually the say currency's name, but that currency is not redeemed, or you cannot exchange that currency for gold. And finally, the government, Zimbabwe government, has also imposed some restrictions on the convertibility of ZiG or Zimbabwe Gold into say dollars, into any other rupees or any other currencies. So there are some restrictions on the convertibility side. Now when we talk about the main reasons as to why all of a sudden Zimbabwe, earlier they used to actually use dollars, right? Right now they are now using gold backed rupee, is because you have to understand a very important concept of the value of money, right? When we talk about value of money, right, we obviously understand that money in this particular sense is actually the currency which is actually permitted for legal circulation in a country, right? That means money is actually a legal tender. In India, for example, we have 100 rupees note, 500 rupees note. Why? Because we have the RBI Act, which is allowing the circulation of this kind of notes and currencies in the country. That means money is having the legal backing of a particular statute in the country. And when we talk about the value of money, we understood the legal definition, or say legal backing. When we understand the value, it means that money is also a fiat money, right? That is, they are issued by the order or decree, right? If the very fiat means that they are issued by the order or decree of a king, say, or for example, it's a central authority, or say in our case the RBI, the Reserve Bank of India, right? And because this is a government institution, and obviously the people's trusts are actually with the government institution, that is what makes possible the issuance and having the value of the Indian rupee, and in their case the Zimbabwe gold. So we have to understand the value of money is very, very important in actually determining the main currency of a particular nation. And when we are talking about this value, we have to go back to Zimbabwe's situation. See, in the 1990s, 80s, Zimbabwe shifted to dollars because simply Zimbabwe was experiencing high amount of hyperinflation. Even this took place recently in 2022 when the inflation touched around 100% annually, and also in March 24 we see that inflation is reaching almost 100%. And it was the case when Zimbabwe had to release $100 trillion, right, as a note, because this inflation is simply too much. So to actually curb the inflation, to curb the amount of losing the purchasing value of your money because of the losing of economic trust, loss of economic activities, poor economic performance, the Zimbabwe government has going with a very safe asset, right, such as gold. Right now, dollars or Indian rupees values are not derived from gold in most of the cases, but they have gone for gold because they want to stabilize their currency. And that is why we have to understand this is a very, very important topic for your prelims, because we have concepts of fiat money, we have concepts of legal tender, and also we have instances where we have seen that there can be some situations when countries take such desperate measures, because gold is always a safe asset, or to stop the slide of their currency they can take such desperate measures. Now this is one MCQ I want all of you to answer in the comments below. Thank you. Recently, the RBI launched 4 initiatives to improve the access of the public, that is the banks and also the retail investors, to the various services of the RBI. And we'll be looking at 4 important initiatives here which the RBI has launched. Now we'll be starting with the very first initiative, which is known as the Pravah portal. As you can see in this portal, there are the scopes for filing new applications for the various authorizations, licenses, and the various aspects of the financial system of the country. Here the RBI has launched this portal. The full form of this portal is Platform for Regulatory Application, Validation and Authorization. This is a centralized web portal of the RBI where there can be many stakeholders such as banks, such as payment service providers, and also the foreign exchange dealers who can actually file their online licenses with the RBI to open up any new businesses or file for any regulatory compliances with the RBI. So on this portal, if any bank or any payment service provider, they want to obtain new licenses, they can easily register by filing new application, and they can also look at the application history, right? So this is a very uniform kind of a digital portal where the applicants, such as this kind of stakeholders, they can easily track their application and improve the time completion and also improve the ease of doing businesses in the country. Apart from granting licenses, this portal can also give authorizations, right, such as opening new branches or offering new financial products by various banks in the country. So we have to understand, whenever a bank needs to expand their businesses branches in various parts of the country, obviously they need permission from the RBI. So here this portal is making the process very easy and very simplified on a digital portal where they can file their applications, they can track it, and they can also do the same here. And finally, this very portal will be also helping the various stakeholders such as banks and the foreign dealers and say the financial service providers to also obtain any regulatory approval such as say mergers and acquisitions of banks and various other financial companies. So it is a very kind of a uniform portal where you can have a diversity of products, and this will be also streamlining the application of getting various services on this portal, right? So whenever this kind of questions they come in the prelims, for example, Prava portal is related to or say has been launched by, please do remember this kind of applications, this kind of current affairs, especially because there have been many questions in the past on this kind of topics. Next, the RBI launched the Retail Direct mobile app. Now here, this is a kind of a mobile app where the people in the country, mainly the retail investors or the common individuals like you and me, who want to subscribe to Government of India's and also the various state governments securities. Now this portal is actually, or say this mobile app is making the investing in the government securities a very seamless process. Now when we talk about say the retail investors investing in government securities, we had in 2021 a very important initiative by the RBI to open up the say avenues of investing in the government securities seamless to the investors. So in 2021 we had this Retail Direct scheme, where this Retail Direct scheme means that investing in the government securities now became very easy for the investors who are from say the retail side or say investors like you and me, right? So we know that the government securities are generally invested by very large financial institutions such as banks, right? Such as insurance companies, such as in India we have the LIC, and LIC is, let me tell you, the largest investor in the country. Okay, so we find that generally the government securities are bought in huge amounts and also by major financial institutions mainly, right? Before 2021 we did not have an opportunity for the retail investors to participate in the government securities market. And when we talk about the government securities, they are generally of two types, right? We have the short-term government securities, right? And the short-term government securities are generally known as treasury bills, right? Which are generally less than, right, 1 year. So these are short-term debt instruments or short-term government securities, and these are only say issued by the Government of India or the central government, right? On the other hand, we have also some things which are known as dated securities. Dated securities are again of two types, right? Dated securities of the Government of India, that is the central government, and dated securities of the state government. These are also known as state developmental loans, right? So we have this kind of categories, and in this portal right now the mobile application has also been launched to actually make this process more seamless for the retail investors. So from this mobile application or also from the online website of Retail Direct scheme of RBI, so this retail investors they can directly invest in the government securities. The minimum investment for them is 10,000 rupees to a subject of a maximum of rupees 2 crores, right? So retail investors can purchase this amount directly from this portal. And we have to understand this, that for opening the retail accounts, right, any Indian citizen can open it if they are having proper KYC compliant and also PAN card linked bank account. And here even the NRIs, the non-resident Indian NRIs have also been allowed to invest in these government securities, right? So here we have to understand the NRIs have been say allowed to invest under the scheme, under the FEMA legislation, right? Under the FEMA legislation. So this is why we have to understand this is a very significant one, because I told you that primarily this was a market where the banks and the many large financial institutions they invested in. Right now it is very easy for the retailers to also invest in this market, right? Now in this kind of a scheme, we have to understand the government securities are invested by the retail investors, and when the Government of India they directly try to say issue the government securities, when they directly issue the government securities to the investors, be it the big investors or be the retail investors, when the government of India directly, right, transacts the same, this is known as the primary market, right, where primary market of government securities, where the government securities are directly issued to the investors, and later the investors can actually trade them to the rest of the people. For example, there is a person A who has bought one government security, right? So this is A, right? And right after purchase of this government securities by A, then A can actually sell to B or C or D or to any other investor. What we refer to this kind of markets? We refer to these markets as secondary market for government securities. So the entire kind of this transactions in both the primary and the secondary market is actually being facilitated through the negotiated dealing system order matching portal of the RBI. This is negotiating dealing system order matching portal of the RBI, right? So this is where we have to understand this is the entire scheme of the RBI to actually help people come to the RBI directly to purchase the government securities. Okay, and these are also the government securities are also known by a very important term known as gilt edge, right? Gilt edge securities, because these are high class or very investment grade or very safe and secure forms of investment, because obviously the government of India is actually issuing, or say the various state governments are issuing the government securities or the bonds here. So there is even, we can understand zero risk of default on this kind of government bonds and securities. And when we understand that this is the main purpose to increase the amount of retail participation, we have to understand this can even lead to higher amount of financial inclusion in the country, because we have to understand that retail investors right now are investing in the stock markets, in the various mutual funds and so on, where these people are having, say, demat accounts with their stockbrokers, right? Because we understand, be it any app, for example Zerodha, Grow and so on, the investors have demat accounts with the individual stockbroker. And when you have this gilt edge account with the RBI, that means this gilt edge account with the RBI is actually the account that retail investors and all the investors are having directly with the RBI. That means in this particular network, the RBI is directly transferring the government securities, or say when the people will be selling the government securities, it is also transferring the same to the RBI. So this is one kind of an account where you can think it is the RBI's account where the government securities are debited or credited to the people. And let me tell you, there are no fees of maintenance for this kind of gilt edge accounts with the RBI. So this is a very, very important step. And further, right now they have even launched a mobile application for the same to make it more easy for the retail investors to participate in, right? So this was the second initiative. Moving on to the third initiative, we find that recently RBI has published, or say released, a database for the fintech, which is known as the fintech repository. Now what is the fintech repository? As we can see here, we have the various financial services based on technology, right? Such as using blockchain, digital payments, exchange, research, digital money, online banking, investment, crowdfunding, and such and so on. If you understand, these are all financial services possible on a digital medium, or say using digital technologies. So financial companies which are based on leveraging the technology for delivering the financial services, they are known as fintech companies. And in India, we need some database of the fintech operators, and this is exactly doing the same thing. So this is providing a database for gathering information on the fintech entities, right, including those who are regulated by the fintech regulators individually, such as NBFCs, payment aggregators, under various other regulators, right? For example, SEBI and so on, will be having the say details on the same on this portal of the RBI. So all the fintech companies are actually invited to join this portal and give a comprehensive database to actually make this entire fintech say scenario in the country easy to regulate, right? Easy to regulate, easy to even say prevent any kind of frauds or any kind of say risks coming out of the same, because we know that there are many financial companies which are involved deliberately in say taking huge loans from the people. They are also sometimes caught deceiving the people in various cyber crimes and so on. Finally, this portal is also acting as a portal to disseminate awareness among the various public in the country. So this will be actually letting the people getting aware of the various companies and their various operations, and it will be giving a comprehensive database in this manner. Now, looking at the last initiative, this is another database where the companies, right, which are adopting emerging technologies, that is why this the database is known as M-Tech repository, where many banks, NBFCs, insurance companies, capital market, they are increasingly using some emerging technologies or technologies which are very new of age, right, such as edge computing, immersive technology, blockchain, artificial intelligence, machine learning, data analytics, right. So we have to understand that many companies right now are using AI, blockchain and these kind of technologies to improve the delivery of the financial products to the people. So that is why the RBI has also launched this repository or database of those companies which are using these kind of technologies to actually regulate the technology even further, regulate the development of this technology, and also leverage the spread of this technology among other companies too, right. So that is where we have to understand this database is also very, very important. And please do remember M-Tech and FinTech repository, which are the data repositories for FinTech companies, and this is for emerging technology companies. And finally, we also have this practice question. Please do let me know the answer in the comments below. Recently, the RBI has updated the gold loan norms, and here we'll be understanding why it is very significant. Firstly, we'll be looking at some important news here. Now, recently, RBI has actually changed the sanctioning of the gold loans in the country. As we can see, RBI's guidelines on the gold loans, loan to value ratio. So RBI has actually changed some of the requirements that the banks or say the NBFCs or say any other financial companies, whenever they are actually involved in gold for loan. Because we have to understand, in our country there are many individuals who actually use their gold to take loans. Right now, there have been many practices, nefarious practices by many of the banks and the NBFCs. So that is why the RBI has actually revised the norms, right? And also, RBI has recently cautioned the banks on gold loan disbursals to fintech startups, right? Companies like Rupeek, India Gold, Odo Money, they are actually not involved in say friendly corporate practices. They are sometimes found duping the people of the real value of the gold, maybe giving less loans or say charging high or exorbitant amount of interest rates on these gold loans. So that is why RBI has also changed these norms. And also, if we look at the data, in the recent few years, gold loans have actually risen over a period of time. And if we find the main data regarding this, right, if we look at this data, over a period of time from September 2021, 22, 23, we find the issual of gold loans is increasing over a period of time. And let me tell you, these are outstanding gold loans, right? So every year, the growth of gold loans in India is presenting a kind of a challenge for the economy. Why? Mainly because we find that gold is actually a safe asset, for the people of the country. And if they are converting their assets into taking loans, maybe the loan can be is actually taken for say educational purposes, for say various livelihood purposes such as say setting up a company or so on. Maybe the loan is sometimes even taken for personal consumption, right? So this is where we have to understand that individuals in the country is actually taking more and more loans from the gold. And we have to understand, if they out of any reason are defaulting on the loans, then obviously they lose the assets because they have taken the loan by actually pledging or giving the gold as a collateral or security to the banks or the NBFCs, right? So we have to understand this is a very important and a very distressing kind of a trend that we can see, that right now Indians are becoming more and more dependent on the gold loans, right? Also, we can understand this in the light of growing economic uncertainty, unemployment, and job security in the economy. And here when we talk about the norms that the RBI has recently revised, firstly, RBI has revised the margin requirements and set the margin requirements of gold at 75%. Now, what is margin requirement? Now, imagine that you have a gold worth rupees 1 lakh, right? For example, you have a gold jewelry, right? That jewelry is right now having this market value of 1 lakh rupees, right? And you, for example, require a loan, and you go with this jewelry to a local NBFC or say a local bank, and you ask for a loan. Now, what do you think the bank will be giving, or say what do you think the amount of rupees that the bank will be giving to you as a loan? Will the bank will be giving you 1 lakh rupees exactly as a loan to you? It is not. Why? Because this gold that you are keeping with the bank is kind of a collateral, right? Now, for example, for some reason, if you are defaulting on the loan, if you are defaulting, or say if you did not pay back the loan amount within a period of time, what will be happening? The bank will be selling your collateral, or say the institutions, financial institution will be selling your collateral. And when the bank is selling your collateral, the bank have to, say for example, go to another gold jeweler. They have to look for the market price. They have to invest some amount. They actually have to invest some amount into selling your say collateral to get back your loan amount, right? So that is why you have to understand that whatever the value of your gold asset is, you will be never getting the full value of the loan as of this manner, right? For example, out of 1 lakh rupees, the bank will be giving you only 50,000 rupees as loans, right? Because the rest of the 50,000 rupees, the bank has actually kept as a caution money, and also to recover the cost of selling that gold if you are defaulting on the loans. Right? So that is what we have to understand. The banks have this margin requirement, or say the banks have to keep, for example, say 50% of the gold as a margin, right, against your loan. So this is what you have to understand is the meaning of the term of margin requirement. And when we talk about RBI has set up 75% as the margin requirement, we have to understand that obviously the banks, whenever it is giving you, for example, say loan out of this 1 lakh rupees of gold, maybe the higher amount of value that the banks are actually giving, for example, the bank has given you 80,000, 90,000 loan out of this 1 lakh rupees of gold. So obviously the higher amount of loan amount that the banks will be giving you, the higher amount of interest the banks will be able to charge from you. Is it correct? The interest amount, for example, if the bank is giving 50% of margin, right? Maybe, for example, the interest rate is 10%. So the bank can earn only 5,000 rupees from you. Now, if the bank is giving you, for example, 90,000 rupees out of this 1 lakh rupees of gold, right? The bank will be now, earning 9,000 rupees as interest. So the higher amount of loan amount that they will be giving, or higher amount of say the loan that is actually given to you, or lower the margin requirement is, the higher amount of interest rate they can charge and make more profit out of your loan, right? So this is where we have to understand the banks right now are keeping very low margins. They are giving loans of very less margin to actually charge high interest from you and increase their profits. But you, on the other hand, for example, you have to, if you are defaulting, you are not only losing your kind of a gold asset, but also you have to pay higher amount of interest rates. So this is the main tactic that the banks are doing, and they are actually giving more loans. Even they are not actually taking into account the repayment capability of the people who are taking the loans, or say the borrowers. So this is where RBI has actually fixed the margin requirement at 75%. That means if the gold value is 1 lakh rupees, you can actually get a loan maximum of 75,000 rupees only, right? Apart from this, the RBI has told that out of this, for example, 1 lakh rupees, you are getting 75,000 as loans. You can only get 20,000 rupees in cash, and the rest of the 55,000 rupee has to be sent directly to your bank account. Why did the RBI do this? Because it has been seen that many people, such as rich business people who are having black money, they are buying gold with black money in cash, and they are actually taking loans from the financial companies in entire cash. So that is where we have to understand sometimes black money is actually converted into white money in form of loans, and later these business people invest their loan amount in their own businesses. So it is also a way where black money is converting into white money. So RBI told right now you can only give 20,000 rupees, a limit of 20,000 rupees in cash, or you have to actually send the rest of the money to the bank account, so that the people who are taking the loans, their bank account, their identity is known to the banks and the RBI at the end of the day. Right? And finally, if people are defaulting on the loans, their gold must be sold in transparent auctions. That means the auctioning, or say the selling part, where we discuss the requirement of the margin requirement, right? We understand that firstly, banks are keeping margin requirements to actually keep some margins, or say safety deposit, and secondly to recover the cost when, say for example, say the people is not paying the loans back. So for that, the auctions must also be very transparent. It must be preferably on a digital portal, or say it must be totally say known to the entities beforehand if they're actually auctioning of the gold. So these are all the things that you have to keep in mind, and the concepts also when you are answering any kind of questions on this. And based on this, I have a practice question for you. Again, do let me the answer in the comments now. Recently, there have been many protests in Philippines regarding the cultivation of golden rice. If we look at golden rice, we can find that this is the normal rice, and this is actually the golden rice, which is actually golden in color. And this golden in color is not a natural one, because this is actually a rice which is genetically modified. Genetically modified. And these are also sometimes known as genetically modified crops, using genetically modified organisms, or GMOs. And when we talk about converting white rice into golden rice, it is very simple to understand, because white rice, we know that rice is a plant structure, right? And it is having obviously a strand of DNA, right? And using genetic technology, we can actually alter the DNA to insert various genes of a specific character. In white rice genes, we insert the daffodil genes, that is actually the genes of this daffodil flower, and also a bacterial gene. So when we cut some strands of DNA here, and we insert this strand of DNA of daffodil and the bacterial gene in this place, we are actually getting beta carotene induced white rice. Beta carotene is actually a very important source of vitamin A, and here we find that white rice is actually having higher sources of vitamin in this manner. But we have to understand this entire process is possible because of genetic modification of crops, and this is actually the main reason why the farmers, why the entire Philippines community and the environmental activists in Philippines and also all around the world are protesting against open cultivation of this golden rice, right? Because as we can see here, recently there has been protests in various aspects of Philippines, and the main concerns of theirs are firstly that GMOs, or genetically modified organisms or crops, or any products out of genetic modification, the long-term implications is actually unknown, because it is fairly a novel, or say a new technology, and the long-term aspects of changing the genetic component of the natural specimen of the DNA, and the long-term effects on the animals and the human beings have not been evaluated and is not been possible so far. So there can be some genetic diseases spreading onto the animals and the human beings out of this. And also the environmental implications. The environmental implications is also a very severe form of say a debate in this manner, because you have to understand this finally white rice is a genetically modified rice, and when they will be cultivated at fields, right, there are chances of decreased amount of pollination in the entire region, and say for example even the various wastes and residues out of cultivating this rice, these wastes and the various pesticides and chemical kind of components which are used in cultivation of this golden rice can actually spread to other plants, and hence the ecological impact and even the long-term ecological impact is also unknown, right? And also various groups are also protesting on say the nutritional aspects versus right, the ethical aspect of changing the genes and playing God. Obviously, we understand that since this rice is containing beta carotene, a very important source of vitamin A. So obviously there can be many people who can be provided nutrition directly from say rice when we talk about vitamin A. But this is one side. On the other side, we are also playing God, right? Because we are changing the natural genes of white rice and modifying it to get something better. So there is always this ethical dimension of changing the natural species, the natural environment to modify according to our own human needs and requirements. So that is what we have to understand. Human needs and wants are unlimited, right? Needs are basic needs, wants are unlimited in nature. So where will be the human race stopping when it comes to the issue and debate of genetic modification or modifying it at a very genetic level? So that is why there have been many protests as of now regarding this particular golden rice. And right now we have this question. I want all of you to answer this in the comments again. According to recent reports, the drop in sovereign bond yields have been witnessed. And this is a very, very important topic for a UPSC examination because the topic of bond yields have been repeatedly asked in the prelims examination. Now that is what we have to start our discussion with by actually understanding what are bond yields in the very first place. Now imagine that you have purchased a piece of land, right? For example, you purchased a piece of land for 1 lakh rupees. And after a period of some time, you actually sold the land at 5 lakh rupees. Say this is after 5 years you have sold it. Now what is the yield of your, say, this particular transaction or this particular profit? Yield is always the extra amount of income that you have earned, or for example, the total absolute amount of money value of your return. That is, for example, the money value of your return over a 5 year is 4 lakh rupees, right? Is the total money value that you have earned as return divided by the total money that you have invested, right? That is the total cost, or you can tell that it is the total money that you have invested. So here in this case, we understand that the return is 4 lakh rupees divided by the amount that you have invested, that is 1 lakh rupees. So the yield in this case is a percentage value of your total return to your total cost or investment. So here in this case it is 400%, right? So always remember that yield is actually this ratio. And when we talk about government bonds or the bond yield, we have to understand, for example, in this case of this government bond, maybe the face value of this bond is 100 rupees and the coupon rate, or say simply the interest rate, is for example 5%. Right? So the people will be buying this government bond. Why? Because we know that the government bonds are very safe as compared to the private company stocks, right? Because the government is always there to stay and the government will not be going away. So that is why people think that apart from the private companies, the government bonds are actually very safe. And that is why also people will be understanding that when it comes to returns, that people will be getting these returns every year up to the maturity period of this bond. For example, the maturity period is 10 years. So for 10 years, the people will be getting 5% returns every year. So that is why the government bonds are actually one of the safest forms of investment. Right? Now let us compare it to the stocks or the shares or the equities that are traded on the stock markets. Now you understand, for example, consider this is company XYZ. This is an Indian company and it also wants to raise money from the markets. We know that the government bond is actually a form of a debt, right? This is a debt because the government wants some money to build schools, roads, colleges and so on. That's why the government takes borrowings from the people of the country. Now for the same reason, the private companies in the country, they also want money to improve their business, to expand their business, right? To expand their business, they sometimes take loan from the banks. They take loans from the market, that is actually by listing of shares in the market, right? The aspect of taking more money is actually to improve business. And by business we mean that maybe the private company will be now expanding their branches, now expanding their operations, and in the same they will be also giving more and more employment to the people of the country. And when people are getting more employment, people are getting more jobs, and people are actually increasing the national income of the country. So obviously we find at the end of the day, while taking government bonds, the government take more debt for building more better schools, roads, colleges and so on, the public institutions. It is good for the country, obviously. On the other hand, we find that if the private companies, they get more money from the market, from the people in terms of shares, from the banks in form of loans and so on, government can, or say the private businesses, they can expand their businesses and hence improve the national income of the country also. So it is understandable that both the government and the private sector, they need money for their own different sets of operations. Now, for example, let us take the case of this investor A, right? Now, this investor A has the option of investing in this government bond, which is having a face value of 100 rupees, coupon or say interest rate of 5% every year, and say for example total maturity period of say for example 10 years, right? Now, if we calculate the yield of this government bond for only 1 year, what will be the yield? That is, after 1 year, this government bond will be giving the investor 5 rupees as the return, right? Divided by the total money that he has invested initially, that is 100 rupees. Remember the formula of yield. This is actually the formula yield where this is the total return divided by the total cost of investment. So here this is 5%. As we can see, this is the same as the interest rate initially, right? Now, on a similar form that we understand that, for example, right now, the company stocks of this company XYZ is listed on the stock exchange and it is giving an average return of 8% over a period of time. And also we can understand that if this is giving an 8% return, maybe this investor who is now having a government bond which is paying 5% in return, he will be thinking that, okay, maybe this stock is now giving me 8%, so this is actually giving me 3% more than the government bond. So what I can do, maybe I can sell the government bond right now for 90 rupees maybe to investor B, and I can invest this 90 rupees in this private company stock, and the XYZ company will be also very happy because right now the company will be getting an additional 90 rupees for say the expansion of the business, and we know that the expansion of the business is actually better for the GDP of the country also, the national income of the country also. So we understand that investor A has invested 90 rupees right now after selling this 100 rupees bond. Now you may be asking me why for 90 rupees? Maybe because at that time, maybe this person B was not willing to pay 100 rupees, or maybe he did not find enough investors in the market because he immediately needed the money to invest in the stock market, which is giving him higher returns. So that is why he sold maybe a little less than the face value. But here something interesting happened. That interesting thing is that for B, if we calculate his yield right now, what will be the yield? At the end of the year, if this B is keeping this government bond till 1 year, we understand that the person will be getting 5 rupees, right, as the interest, right? And for example, if the government bond is also for 1 year of maturity instead of 10 years now, so the person will be also giving, getting back the 100 rupees from the government back, and also plus 5 rupees. That is at the end of the year. At the end of the year, the person is getting 105 rupees, but out of what investment? Only 90 rupees after he purchased the bond from A, right? So what is the total amount of say profit that he made? The profit or return that he made is say excess of 15 rupees. And out of what investment? 90 rupees, because this is not 100 rupees. 100 rupees is actually the cost of A for this government bond, but A sold it to B for 90 rupees. So that is why yield would be around say 16.6%, right? When investor B is actually keeping the government for 1 year till maturity. So we find that actually at the end of the day, who won? Actually B is getting 16% returns on the government bond because he purchased it at 90 rupees, and A is getting 8% returns, right, from the private bond or say the private stock. So we understand that B is actually in a better place, higher yield on this particular government bond. Now A will be seeing that, okay, B is getting 16.6%, but I am only getting 8% on this stock annually. So what will now A do? A will again try to say go into this government bond. Why? Because this is giving higher return. But again we understand the private company will not be happy, because if now the private company wants to actually increase its investment or say increase in borrowing from the market, right, it has to now pay more money or say more returns, say excess of 16.6%, because 16.6% already the government is giving to B, right, in terms of yield, not interest rate, in terms of yield, that is a market yield, right. Now this particular private company now has to, for example, offer say 17% interest rate or say 18% say return rate on any of the new borrowing that the private company will be doing. So when we understand, this is increasing the cost of borrowing. This is increasing the cost of borrowing for the private companies, and that is what we have to understand, that when the say price of the government bond decreased to 90 rupees, right, the yields of the government bond increased from 5% to 16%, right. So we find that the yields have increased when the government bonds price is decreased. So this is what we have to understand, when the government bond prices decrease, the yields increase, and this is not a good picture for the private company here, because they have to now offer a higher interest rate that is more than 16%. Correct? So that is why it is said, whenever the government bonds yields increase, it is not actually good for the private sector, because simply the private sector costs or say borrowing costs, say they increase. So this is the main reason why government bonds increasing is not good for the entire economy, because right now the people will be investing in say the government bonds, not in the private sector. If the private sector is not getting the money, then who will be expanding the businesses, giving employment, jobs, opportunities, and so on. And finally it will be impacting the GDP also. So this is what we have to understand. This is the inverse relationship between price and government bonds yield, or say for that matter any bonds yield, right. It is always inversely proportional, right. Now this is the main aspect here. Remember for all your future references that whenever government bonds yields increase, that is not good for the economy. That means people are actually siding more with the government and not going with the private sector. And this is actually a very, very serious aspect, and that is why the RBI and also the government of India never want the yields of the government bonds to increase. Right? So this is what we have to understand, the significance of this yield topic. Right? Now the similar other case can also happen if the prices of the government bonds increase. Right? The yields will be decreasing. So it is better for the economy that the prices of the government bond increase. For example, earlier in this case we had the price of 100 rupees. Right? And if the price right now increases to 101 rupee, at the end of 1 year, we have seen in our example that the person will be getting 105, or that person will be only earning 4 rupees. 4 rupees out of investment of 101 rupees. Right? So we can understand the effective yield is even less than what is the interest rate on that, or say the coupon rate on the bond. So we understand the increase in price will be decreasing the yield of the government bonds. So we can understand this is an inverse relationship which is always operating. And this is what brings us to the factors that affect the bond yield. The very first factor that we have seen is actually the sentiments of the market, right? The sentiments of the market, towards the government bonds and the private sector stocks. Right? The greater the optimism that the people of the country will be having on the private sector, the greater the optimism, the greater the confidence, the more people will be investing in the private sector, right? So that is what will be leading to better outcomes, and also this will be leading to decrease in the government bond yields. So this is actually a matter of sentiment first. Second, we have to understand that it also depends on the market interest rates. It also depends on the market interest rates. Now consider that, for example, your bank interest rates is, for example, at 8%. Right? The bank interest rate is at 8%. Okay. And for example, your government bond interest rate is also at 8%. Now for some reason the bank interest rate rose to around 12%. Now what will you be doing? You will be obviously selling your government bonds. You will be selling your government bonds to invest that money in your bank account, because simply you are getting higher interest rates, right? And now when you are selling the government bonds, you are actually increasing the supply of government bonds in the market. And when you increase the supply of government bonds in the market, you lead to the decrease of price of that particular government bond, right? So when in market interest rates rise, it can be interest rate of your bank account, any other financial account, right? When the market interest rate of your market interest rate increases, it leads to the reduction in the price of the bonds. So again we find that when we talk about interest rates are indirectly proportional to the price of the bonds, because whenever bank interest rate increases, you sell off your government bonds and invest that money in the bank account, and that is why when you sell, you increase the supply of the government bonds, and this leads to the decrease of prices of the government bonds. So that is why it is inversely proportional here also. And when we talk about increase of interest rates and its impact on the government bond yields, what happens? Since interest rates increase actually is inversely proportional to the prices, when interest rate increase, the prices will be going down, and we know that price and yields are also inversely related. When prices will be going down, this will be leading to increase in the yields also. So generally, when interest rates rise in the market, when the interest rates rise, it leads to finally the increase in the government bond yields, right? Because of this manner. Firstly, because interest rates are inversely proportional to bond prices are inversely proportional to yields, and that is why when prices decrease, yields rise, right? Now the second aspect, the third factor here, the third factor is the amount of inflation in the economy. When the inflation in the economy increases, we understand what the RBI will be doing. RBI will be immediately increasing the repo rate. Now when RBI has increased the repo rates, what the RBI had did? RBI actually increased the interest rates in the economy. And we know already from the previous discussion that interest rates rise and price of the bond falls. When the price of the bond falls, yield increases. So that is what leads to higher amount of inflation, leads to higher amount of repo rate, because obviously the RBI increases repo rate to increase the interest rate to decrease the money supply in the economy. And this leads to the increase in yields also. So that is why when we have inflation, it is actually not good for the economy. It is not good for the economy, because people right now during inflation, they try to invest in safer government bonds. They invest in safer government bonds, and that is what leads to the increase of yields of government bonds here. And people do not invest in the private sector during high cases of inflation due to reduced amount of market sentiment and optimism also, right? Then also we understand that whenever we are talking about the government bond yields, right, we also have to take in the aspect of borrowing costs. Now say in that example of ours, that government bond price decreased from 100 rupees to 90 rupees, right? It decreased to 90 rupees, and in this resulted in the increasing amount of yields to at around 16.67%. But the interest rate that the government actually paid on this was 5%. It was a coupon rate of the same. Now, for example, when the government would want to issue a new bond in the market, right? For example, this was bond series A, and when the government would be launching series B of government bond, so now the government bond will be having the same face value, but now the government also has to match this yield, because this yield already people are getting in the market via market transactions of these yields. So right now maybe the government have to release this government bond maybe at 18%, because the people will be simply not investing if it is less than 16% like this manner. So if you are offering higher interest rate as a government, obviously you will be increasing your borrowing cost, and increase of borrowing costs will be leading to more and more fiscal deficit of the country. So that is why increasing yields is never good for the economy also, right? Achha. Then we also have the impact, the fifth impact, where we talk about the some positive developments, such as increasing amount of surplus transferred from RBI to the government. RBI to Government of India. Recently we found that RBI has recently transferred around 2.1 lakh crore to the Government of India. Now what happens when the government is supplying more and more surplus, right, to the Government of India from the economic capital framework, which is actually the last topic which is covered in this video itself? It is actually increasing the amount of money that the government actually spend right now on the various, say for example, roads, right? For example, infrastructure activities, schools, colleges, and so on, and also on the various welfare programs of the government, right? So right now the government can use this money on all these activities, and government need not even use or say issue government bonds, right? So this will be leading to actually decreasing yields of the government when a positive development such as these things happen in the economy, right? So these are all the factors that actually affect the bond yields. And in the real world, what has happened as of now, as we can see here, over a period of time from 2023 July to April 2024, we find that the government yields increased over around 7.4% to reach around 7.4%. That is, yields were at high level. Why? Because in this period, in this entire period, right, we also have seen various global conflicts such as Russia-Ukraine crisis. We also have seen the cases of high amount of inflation, particularly inflation in the food items, right? And that is when the RBI was also increasing the interest rates. And we know when the repo rates in the market increase, the yields also increase. So that is why we find that the yields have actually increased over a period of time. Okay, and we find that over a period of time recently, the yields are actually decreasing, and also yields are decreasing as of now recently too. Recently, it has actually came onto a very kind of a comfortable level at around 7%. The 10-year government yields have come to around 7%. That means the yields are actually decreasing on the front of optimism in the private sector of the country. Because from say around April to May, the elections were actually going on, and there was this optimism in the market that the government will be taking more and more pro-private sector reforms that will be leading to better economic conditions. Better economic conditions mean less amount of inflation, more amount of participation in the private sector, better functioning of the stock markets, and also more participation of the foreign portfolio investments. So this will be also leading, these are actually the main reasons as to why the government bonds are actually declining over a period of time. And hopefully this condition will be continuing, and we know that the lesser the government bond yields are, the better it is for the economy. And here we have a question for you all. Please do answer this in the comment section and let me know. Recently the RBI has released Fair Practices Code to actually improve the lending ecosystem in the country. Now, according to this code and according to the various unfair practices followed by banks, we have to understand banks in the country are right now following some unethical practices to improve their profits and improve their business. So the very first thing that they are doing, that for example, it has been seen that in some cases the banks are actually charging interests even before the disbursement or say the release of loans. For example, say you go to a bank for asking, for example, 10 lakh rupees of loans. You go to the bank on 1st of January and the banks have, say for example, completed your proposals and your say paperworks on, for example, 2nd of January, and finally everything is done on 2nd of January. You go to the bank, you have signed the papers and documents, and finally the banks have transferred you the money of this loan on, say for example, 10th of January. So ideally, normally we understand that the loan date must be starting from the time when you have actually been transferred the money in your bank account. But what the banks are doing, they are starting to charge the interest rate directly from the time when you went to the bank, also when you started to file the paperwork and you sign them. So before even disbursement, that is sending the money to your bank account, the banks are counting the interest rates. So it is actually leading to a loss of interest, right? Or say loss of money to the borrowers. Second thing which you are doing, they are also, for example, for any loan, right? The banks can also give you a check. The banks can sometimes also give you a check, and you know, on checks we have some date written on the top. So for example, the bank has given you a check dated, for example, 1st of January, and you deposited the check on your bank account, and finally the bank has actually sent you the money to your bank account via this check deposit as, for example, say 10th of January, right? Now ideally, again, you should be actually charged interest rate from 10th of January, right? But that is not happening. The banks are actually charging the date, the interest rate from the date of the check. Then what the other things that the banks are doing, they are levying full month interest payments on the partial, say for example, loans. For example, you have taken a loan for only 20 days in a month. For example, you have taken a loan of 10,000 rupees for 20 days, and along with interest rate, you will be submitting the loan to the bank within 20 days only. But it has been seen that the banks have levied the interest rate for one full month. Again, this is an unfair practice, because you should not be paying the 10 days interest rate, right? This is extra money that you are paying, and unethically also you are being imposed this kind of rate. And finally, the interest rate on unpaid installments is also being calculated. It can be understood in this manner. For example, say you have taken an EMI from the banks, right? You have taken an EMI from the bank, and for example, this EMI you have taken for iPhone, and every month you have to pay, for example, 10,000 rupees. 10,000 rupees to the bank. Now say you have made the payment on January, the payment is done. You have made the payment on February of 10,000 rupees. And when it comes to, for example, say March, maybe on March you have, say, missed the payment date. That is, you have made a default, right? So what do you think? That the penalty charges, or say the various other kind of extra interest rate, should only be levied for the month of March, right? But what the banks are doing, on the month of April, on the months of May, on the months of June, July, or whatever the term of the EMI is, they are levying all of this penalty and interest on the rest of the months too. So this is another unfair practice which the banks are actually doing. So to curb all these things, the RBI has come up with this fair practices code, where all of the, say, EMI charges, the tenure, the interest rate, all the hidden charges, everything must be communicated on the official paper via SMS, via email, via, say, direct communication to the customers by the bank. There should be no hidden charges, there must be no excess charges in this manner. And also, the customers will be given an option to switch to a fixed interest rate. Now, when we talk about fixed interest rate, we understand that in the economy, the interest rates always change, right? They always change based on what? Based on the benchmark rates. Benchmark rates are the, for example, say in our case, the repo rate. Now RBI time and again revises their repo rates, and based on the repo rates, the banks actually take loans from the RBI, right? Actually, it is known, it is actually told that the repo rate is actually the base kind of, say, cost of borrowing for the banks from the RBI. And finally, if the repo rate increases or decreases, the interest rates in the economy will also increase or decrease in this manner, right? But the thing is that there are some kind of loans on which you are taking loans based on fixed interest rate, and also there are some kind of loans where you are taking loans on floating interest rates. Floating interest rates are exactly this: whenever the repo rate will be changing, your interest rates will be changing. So it actually, for example, you have taken a loan for a home, right? And this is actually spreading over 30 years. So ideally you would want your interest payments to remain fixed over 30 years, right? So for long duration loans or even for medium duration loans, customers always prefer a fixed interest rate. For example, say 10%, for example, say 12%, fixed forever, right? Now, there are some banks which are charging the say customers floating interest rates, and also they are adding many other charges with the floating interest rates, making the final interest rate much more higher. So that is why the customers will be also given options in a while sometimes to switch to fixed interest rate. So actually have this security of say no change in their interest rate liability over a period of time. So this is what the RBI has done here. And here another question for you to actually solve. According to latest news, it has been seen that the post of the SBI top management is vacant, and that is where the Financial Services Institutions Bureau is interviewing for the various vacant posts of the State Bank of India. So that is what makes this topic very, very important. And as we can understand, the Financial Services Institutions Bureau, FSIB has actually replaced the Banks Board Bureau. Banks Board Bureau earlier was actually responsible for the appointment for the posts of various top management officials in the public sector banks. So right now they have, this bureau has replaced Bank Board Bureau because this was faced with many issues, and this was actually not operating with proper mandate and proper amount of surveillance. That is why recently the government has instituted FSIB. FSIB is under the Department of Financial Services. This is under the Ministry of Finance, where they actually look into the appointment. They look into the appointment of various full-time directors, and also non-executive chairman, right? Non-executive chair people. So the top management of the banks, the state-run banks such as SBI, Punjab National Bank, and so on, their directors and their non-executive chairman is actually appointed by FSIB, right? And when we talk about the appointment of them, it is very, very important that the top management must be very impartial, and they must be having good qualifications to lead such huge state-owned banks. And that is why we have to understand this is a very, very important body. Apart from this, they also appoints the general manager of major insurance companies. That is within the state ownership. Okay, and here we have to understand the structure of this body. The structure of this body is that at the top we have in the FSIB we have a chairperson. And this is actually a central government nominee, that is the Government of India nominee, appointed by the Government of India. And apart from this, we also have the Secretary of the Department of Financial Services. We also have the IRDAI appointees here, and also we have the Deputy Governor of RBI within this body here, right? So this is the main structure here. Apart from this, we also have 3 more part-time members who are actually experts in economics and management in the banking sector. So this is the entire thing that you want to know regarding FSIB. And with reference to discussion here, I want all of you to answer this question in the comments. The last topic for today is economic capital framework, where recently the RBI has transferred a lot of amount of money as a surplus to the Government of India under this framework. And this is a particular framework which is actually looking into the various incomes and expenditures of the RBI, and finally at the end of the day, surplus of the RBI in terms of INR. And this economic capital framework we have to understand according to the recent annual report of the RBI, where the RBI has released this trends in income, expenditure, net income, and the surplus transfer to the central government of India. And this is according to the RBI's recent balance sheet. We can understand that RBI as an institution, it is a central bank of the country, right? And it has also some sources of income. For example, the incomes can be coming from the various amount of, say, interest rates charged under the repo rates, and the various other incomes of the RBI from various investments in Indian securities, abroad securities. So RBI as an institution is having some income. And also apart from this, RBI has also some amount of total expenditure or some expenses. That expenses can be due to various staff expenses, it can be due to some bad loans that the RBI has given to the banks, it can be due to the various depreciation of the assets of the banks, right? And also we have to understand that RBI has a total income of around, say, around say this much and expenses of this much in the year. And finally, the net income of the RBI, as you can see here, the net income of the RBI is around 2.1 lakh crores. Right? We can understand the RBI itself is a treasure trove of a huge amount of revenue itself. And what the government RBI will be doing with this revenue? RBI will be transferring this revenue, apart from adjusting some other kind of costs here, to the government of India. And this is actually under the recommendations of a very, very important committee known as the Bimal Jalan Committee recommendations, where under the RBI Act, the RBI is actually mandated to transfer whatever surplus it has generated over total income and expenditure to the government of India, right? Because what the RBI will be doing with this money? Maybe this money will be required by the government of India for the various social expenditures, capital expenditures of the government. Because at the end of the year and at the end of the time, RBI is actually a part of the government of India. So it has to transfer the money to the government, and this was actually a very, very important recommendation of this committee. And here we have to understand that when we look at the entire balance sheet of the RBI, we find that RBI itself is having some liabilities and assets. Now these are very, very important terms for your prelims, right? When we talk about the liabilities of the RBI have some capital, have some reserves funds, also the deposits of the people, right? RBI, according to this Bimal Jalan committee, has to also keep a comfortable amount of contingency fund. Contingency fund is actually emergency funds for meeting up any BOP or say balance of payment crisis and so on. Then it has also some asset development funds and various other liabilities of the RBI. Now when we are talking about our liabilities, we are obviously talking about the kind of resources that is not RBI's own, right? Maybe RBI has taken loan from someone, right? Or maybe the total deposits of the people or say of the banks, right? Indirectly of the people also. Also, when we look at the asset side, we find that on the asset side, the RBI is having some assets like notes, coins, gold, investments in foreign, right, domestic, and also loans and advances, and various other assets. As you can see here, where the various assets are actually divided in the RBI in under two headers: the banking department and the issue department, right? So under two departments individually, we find there are many other assets of the RBI also. So that is what we have to understand, that the total assets and liabilities of the RBI are having this kind of effect, and it is the main, we have to understand the assets are the main source of income for the RBI, and that is what has given around 2.1 lakh crores, right? The entire assets, this entire component has given this much of say huge revenue to the government of India. And here, when we talk about the source of transfer or say the source of surplus this year, mainly we have to understand the interest component. As we can see here, the interest component is a very, very huge form of say income for the RBI. The interest is actually say coming from say the repo rates, right? And in this year, in the last financial year, the main actually income came from the variable repo rate. Now we know that under a repo rate transaction, what happens? The banks take loans from the RBI, and in return, right, the banks actually give some interest rate. This is actually interest rate which is known as the repo rate. So you understand, right? This interest rate is a kind of an earning or profit for the RBI. So this is actually a very, very important factor here. Now what happened? The RBI right now is conducting various variable repo rate transactions, right? That means that under repo rate, what happens? The RBI is actually fixing, for example, say 6% as repo rate, for example, right? Now RBI is itself fixing 6%. What happens under variable repo rate, as we can understand from the term variable, right? It happens that the RBI is opening auctions, or say a place where all the banks can come, all the banks of India, for example, Bank 1, Bank 2, Bank 3, right? They are coming to this auction, and for example, everyone is requiring, for example, 1 lakh crore. This bank is requiring 2 lakh crore. This bank is requiring, for example, 3 lakh crores as loans from the RBI, because banks take loans in huge amount. And based on this auction, the various banks are actually bidding. For example, if you this bank one is telling the RBI that if you give me 1 lakh crore, I will be giving you, for example, 6% repo rate. This bank is telling, if you give me 2 lakh crores, I will be giving you, for example, 6.1% repo rate, and so on. So all of the banks will be presenting their own individual values of the repo rate, and here the RBI will not be fixing any repo rate on its own. It will be totally left to the banks or in a market-like condition. Now, based on this only, the RBI will be selecting one bank and its repo rate, and this repo rate will be fixed across all of the banks, right? So this is actually one of the major sources where the say income of the RBI has actually come from, the variable reverse repo rate transactions. So banks here have submitted their own versions of the repo rate, and this is actually a major source of interest earning for the RBI in this year. And when we talk about variable repo rate, we can also talk about variable reverse repo rate. We know that reverse repo rate is nothing, just the opposite of what takes place in repo rate. That means here the banks are actually giving loan to the RBI, right? The banks are actually giving loan to the RBI, and in return the RBI is actually giving interests to the banks. So this is just the opposite, and exactly just the opposite of actually the variable repo rate that we have seen in the case of variable reverse repo rate. Similar case here, the banks are actually coming into the auction and they are submitting their own versions of the interest rate to the RBI. The various banks will be there, and finally RBI will choosing one interest rate, which will be the variable reverse repo rate. In very simple terms, this is actually what variable repo rate and variable reverse repo rate is. And according to the latest transfer, the variable repo rate, right, this is actually a source of earning of interest rate for the bank. This is actually one of the reason why the surplus has been seen in huge amount this year. The second is actually the increased amount of forex or foreign exchange with the RBI, because as we have seen recently, the foreign exchange of India has been increasing over a period of time. That is also one of the reason why RBI has realized a huge amount of surplus, right? And also with reference to the various domestic and foreign investments of RBI in various securities, say government securities, say securities of the US Federal Bank and so on. So RBI also has invested in many other institutions and many other investment opportunities such as securities all across the world. So from the securities also RBI has earned a lot of money, and that is what has actually translated into this amount of income, that is around at 2.75 lakh crores. Out of this, the RBI has total expenditure of around 64,000 crores only, if you compare the income. And finally, the total money that the RBI has transferred to the government of India is around at 2.1 lakh crores here. And if you ask me right now what the government will be doing with all this money, the government actually need this money, right? If you look over a period of time, right? Firstly, RBI, as I told you, according to the Bimal Janan committee, right, has to maintain a contingency fund, which is a kind of an emergency fund to actually meet any kind of balance of payment crisis, or for example, if the rupee is depreciating too much, RBI can actually spend money from this contingency fund to actually actively buy or sell dollars in the market. Right? So for this, the RBI also needs a lot of contingency fund. If you can look at RBI's balance sheet over a particular period of years, right, RBI has been increasing the contingency fund. And it is actually a very good sign, because the more number of contingency fund, or say more amount of rupees that we have here, the better will be our ability as a nation, as a central bank, to combat any of the volatility in the international markets or in the currency markets and so on. Apart from this, if you look at the trends of the RBI payouts to the government over the years, we find that this is actually the highest in a matter of around from 2016 to 2024. And over the last 3 financial years, from 22, 23, 24, we find this trend is increasing. Right? So if a question comes that over the last period of 3 years, surplus transfer to the government from the RBI has increased, this would be a true statement, right? And also now if you can see what the government will be doing on this money, with this extra 2.11 lakh crore, right, the government can achieve 0.4% reduction in fiscal deficit, which is very, very important for the government, because right now the government of India is doing something which is known as fiscal consolidation. When we talk about fiscal consolidation, this means reducing the amount of expenditure on various items to actually reduce the fiscal deficit, which actually had peaked during the COVID-19 crisis. Right? So this is one opportunity. Second, the government can build 5,740 kilometers of national highway, which is a very, very important task of infrastructural development. The government can also construct around 17 lakh rural houses, particularly when right now the government has approved 2 crores houses to be built under Pradhan Mantri Awas Yojana Gramin. That is a rural portion here. So out of 2 crores, 17 lakh houses can already be built. Then if government of India wants to increase the annual subsidy or say income support program to the farmers of the country, that is right now 6,000 rupees per year, it can increase into 3 times to 18,000 rupees per month. Per year under PM Kisan, right? Then the government can also cover 9 crore hospitals admissions under PMJAY, right? Then it can also extend the food subsidy by another 7 months, and it can also provide free cylinders to beneficiaries for around 3 years, right? And also it can spend on road capital expenditure, Manrega, total subsidy bill, and all of the things here. That is this entire 2.1 lakh crore. They can be used in all of these activities all at once. So it is also a very, very significant portion of earning for the government of India. And finally, I have this question for you all. This is on the economic capital framework. I want all of your answers to not only this question, but also all of the questions that we have discussed here. So I hope that this entire discussion was very fruitful for your learning experience, and I hope all of the content has enriched your understanding and also your notes. So thank you for this time. We'll be again meeting you in the next month with the economy portions of infrastructure and the various aspects of Indian economy. So with this, all the best for your future endeavors, and I hope that you all will be doing great in your preparation. Thank you.